Now I would like to welcome our speakers for the last and the fourth plenary session. On behalf of CII, I welcome Mr. P.R. Ramesh Kumar, Independent Director. I welcome Mr. P.H. Ravikumar, Independent Director. I welcome Mr. Ramesh Subramanyam, President and Group CFO, Hinduja Group Limited. I extend a welcome to Dr. J. Sridhar, Company Secretary, Bajaj Auto. And I also welcome Mr. Prerak, Partner, R.A.I.S.E and Partners. Welcome all of you. Over to you, Mr. P.R. Ramesh, please.
Good afternoon and welcome to the last session of today's event. Hopefully, as they say, last but not the least, I presume that will be so. We had an interesting comment from the earlier session saying everything is a risk. So therefore, this is also a risk session then. Audit is a risk, auditors are a risk, audit committee is a risk, related party transaction is a risk, financial reporting is a risk. We have a very interesting session covering a very wide range, beginning from the whole governance, which is audit committee, auditors, etc., financial reporting, which is the end product or the most visible product of corporates, and a lot of decisions are taken, and all perceptions and realities also revolve around this whole subject of financial reporting. And then the most difficult topic, which is related party transactions, and I don't think we'll ever see an end as far as legislation in this is concerned. So I won't spend too much time on initial remarks because we've already lost nearly 20 minutes of the session, and if all of you have to go home in time, we will have to try and end in time. We have a very impressive panel here. The credentials are great. We have Mr. Ravikumar to my right. He's been a banker, he's been part of exchanges, independent director, an expert in financial services. We have Ramesh to my left, Ramesh Subramanyam, been with the Tatas, now Hinduja Group CFO, and then another industry representative, Dr. J. Sridhar from the Bajaj Group, and extremely knowledgeable, including in laws because the company secretary also with qualification. And we have from AZB, we have Prerak Ved. I think he's the last word on law, and maybe the first word too. So let me very quickly take you through what this session will look like. This is not going to be a session where we will lament on the past or what's happened and why and whole host of things. What we really want to start trying to achieve is, what is it we need to do? What should be the future? How can we shape that future so that we don't have the same things what happened in the past or the present? And the subjects being such, we could spend days, we could talk till the cows come home, but let's be more focused on what we need to do in a very crisp manner. The first one is the role of audit and auditors and audit committees, etc. They play a very important part of governance because auditors provide assurance in financial statements. Audit committee today is perhaps the committee in the governance space which has to do a lot of heavy lifting. Perhaps of all the committees which are mandated, I think the audit committee has the biggest task and the most responsible task. We can talk about structures, and typically our natural reaction is to say, we need to change composition, we need to do this, we need to do that, appointment of independent directors, appointment of independent auditors. We seem to spend a lot of time on structural matters, not realizing that that's not the issue. The issue is conduct. The issue is outcomes. It doesn't matter whether you pick somebody from a data bank and then appoint, or whether you pick somebody, whether you have 2 auditors, you have 10 auditors, that's not the issue. So in that same breath, I think we also need to look at, we say everything, audit committee is great, these are the roles and responsibilities. Have you paused to think, what is the time available for the audit committee to discharge all of those roles and responsibilities? Audit committees meet about minimum 4, maybe a maximum of 8 or 6 to 8, varying from companies. Each time maybe 12 hours, 10 hours, name it. So on an average, you're talking of anywhere between 60 to 75 or 80 hours in a year. Do you expect that 80 hours can produce miracles, given the list of responsibilities of an audit committee? So we can specify a lot, but the question is, how do they do it? Can the most brilliant chartered accountant, being a member of the audit committee, look at presentations which are made of financial information and then suddenly discover frauds and discover everything which is wrong? The answer is no. Can he be given a 300-page financial statements in the morning because you have the issue of unpublished price-sensitive information and you don't give him financials 1 week in advance because it's a listed company, blue chip, information can get leaked out, and he comes to the meeting in the morning, he has to read that 300 pages in between the presentations maybe, and then expect by evening all the results are out, everything is over. How do you actually make things effective? Similar is the next subject, which is on auditors. We have auditors, we have had issues with corporates in India and abroad from the time of Enron or even before, but corporate failures continue to happen. The question is the auditor at fault? Do we need to change something of the auditor? Is it only about ensuring more pairs of eyes like joint audit, or is it about appointment process? We can think of all of it. But finally, what is it which will create that outcome? Prevention of fraud and error, or detection of fraud and error, ensuring quality of financial reporting. How do we make that auditor's role more effective? Do we need to change the purpose? Do they need to be accountable for frauds? Nobody is asking them to be accountable to detect needles in haystacks. We want them to detect the elephant in the room at least. You can't cover up saying with caveat saying, I'm not responsible for this, I'm only responsible for doing an audit in accordance with auditing standards, which I have written, which I only understand, and that's what I state in my report. That's all. So if you look at audit reports, one audit report will look the same as the other. If somebody has spent 10,000 hours doing an audit, another has spent 10 hours doing an audit, both will have the same report. Is audit quality the same? Some of these questions are coming up in these days. How do we get the outcomes which we want? Today I read an item which the present Institute of Chartered Accountants said, size of an auditor is not relevant insofar as quality is concerned. So essentially what it means, that if you have a very large firm, it doesn't mean it's great quality. Equally, if it's a very large company is audited by a one-person firm, it doesn't mean it is poor quality. I mean, if I were to interpret his statement saying quality and size, there is a relevance perhaps of quality and size too. Some of these questions is in the subject which I would request panelists to touch upon. The second is the subject of financial reporting. Again, we need quality, and quality has 3 components: relevance, reliability, and timeliness. Are financial statements today relevant for decision making? Are they adequate to tell you what you need to know? Are all what information, if you really look at the value of a company in the stock market and the value of the company as per the books, there's a huge gap. Why is it so? Because there is value which is not reflected in financial statements. It has its own purpose. It's on historical cost maybe. It doesn't capture intangibles. So the subject of relevance is critical as far as financial. What do you want to see in financial reporting? Forget about the past. Because if you really look at, in 100 years, nothing great has changed in financial reporting. The balance sheets look the same, barring a few new items like goodwill, etc., because of M&A activities. You also have this issue of reliability. What should be the standards? How do we ensure reliability? Is it more auditors? What we need to do? That's the third. And the third is the subject which I think will be core to the preparers like Sridhar and Ramesh Subramanyam. Is quality improved by having more frequent reporting, quarterly, fortnightly, or half-yearly, or annual? Is quarterly reporting actually eroding quality? Again, you crash the timelines. At the same time, the balance between in timeliness, which is the third element of quality, information which is too late is useless. World has moved ahead. How do we get all of these three things as far as quality? And the last subject, which we will talk with the panelists, is on related party transactions. There's so much focus. All related party transactions are now bad. Abusive related party transactions is what we need to achieve. Is all that achieved by correcting processes? Can we really comply? What is it we need to do? And no better person than Ved here, who would have been advising a lot of companies, given the new changes, as what needs to be done. Sridhar has been dealing with it. So is Ramesh Subramanyam here, because these are people who have to actually comply. If you have, let's say, 1,000 related parties, it's likely, it's definitely not unlikely. If you have, say, 300 subsidiaries and look at the key managerial personnel of those companies, look at their relatives, 1,000 is not a small number at all. How do you care? What is the purpose? This is an interesting subject. So let me begin by asking Ravikumar, your thoughts. You can pick and choose any of these. I don't want to be structured in questions, but clearly I would like you to look ahead in terms of what needs to be done. What is the problem? What is the root cause? What needs to be done? How can it be done?
Thank you, Ramesh. I think you have set the tone, and I am a firm believer that history is good for learning lessons, and today and tomorrow are more important. And with that, I would, you covered three specific paradigms. You said relevance, you said reliability and timelines. I am broadly covering three important areas which have emerged in recent years as driving what audit committees in particular and boards in general do. One is evolution of regulations, the second is governance, and the third is security. So each of them, on each of these three, relevance, reliability as well as timeliness, I would only say that the relevance of and the applicability of the accounting standards has been a major issue given the diversity of the participants whom the standards cover and the size of the entities. Like, for example, I would look at capital adequacy. I'm giving an example in banking. Should the capital adequacy, there are no easy answers, I considered right up front, be same for State Bank of India and a small cooperative bank or Punjab and Sindh? I believe that the regulations need to stipulate a minimum and increase them for entities, say, which are listed or which have grown beyond a defined size. But today, the way all regulators in India operate is, it is the same regulation which applies to, let us say, the largest of the institutions. If you take insurance, Life Insurance Corporation of India, and there are some 40 and odd insurance companies. The smallest one, I don't even know the name. When you have a regulatory setup of this sort, you come down to the lowest common level for everybody, which actually systemically is not, in my view, very, very correct. Therefore, I would suggest, and I think Ramesh is in a good place to push it forward, the NFRA should relook at the way accounting standards are set and the way they are reviewed. I believe there has to be a mandatory review of all accounting standards which impinge on the regulations, because the regulations also rely on accounting standards in certain aspects, and every 2 years, and see whether they need. It is not only when there is a problem in the corporate world. It is irrespective of it. I don't think NFRA does that today. The second is the regulations, should they be principle based or should they be rule based? Actually, from the boards, it is very easy if it is rule based, because the regulator has applied the mind and says, you shall do so, we apply our mode. An important, I chair the ICICI Prudential Trust Board, which is the other side of the ICICI mutual fund, because the mutual fund AMC is appointed by the trust and we are responsible to the investors. The more responsibilities are being transferred to the trustees. No problem with that. But they would want a combination of the two, that the ethos of a rule would be determined by the regulator, and we need to implement it having regard to the ethos of the rule. I think that is not fair. You define the framework saying this is the principle, and individual board having relevance to its own operations must apply its mind and decide within this framework what it can do. So either it can be a combination also, but in an area it has to be either principle based or rule based. A related issue which comes in regulations is the structure of whether you take banks and mutual funds. I am taking only these two in my comments, and not insurance and other areas, because these two are really large. Today the mutual funds have come from nowhere to be close to 22% of banking industry. And the way they are going to be, everybody is clear, they are going to be 30% of banking industry by the end of third year. Now, banking industry has always been looked at as also funding social requirements. You have CRRSLR, which funds the government borrowing. You have priority sector advances, which goes to defined sectors which are seen as growing industries and industries which need to be supported. You are aware that in the last 5-6 years, banks have come through a problem, and during this period, the AAA and AA borrowing is substantially shifted from banks to mutual funds. Now, should mutual funds, these are large policy decisions. I am not saying they are easy decisions. Should mutual funds have, for example, be also asked to subscribe a small amount to SLR, CRR? I know I am making very controversial statements. For example, should they be asked to also invest in, because they do equity funding, in a given set of startups? If mutual funds are going to double in the next 5 years, and banking industry is regaining its momentum after slowdown in the last 5-6 years, you need to rule. The regulators today are control, but all regulators have actually two important functions, and the first one is not control, first one is development. Now, when you say that the mutual funds today are going to double, I don't know how many of you are aware, but the top 9 mutual funds constitute 70% of the assets under management. Actually, the others are simply, from a regulatory point of view, not relevant. If you take State Bank of India, ICICI Bank, and the merged public sector banks, they would constitute almost 75-80% of banking system. Now, would you have a single regulatory system which is an important function overseen by the audit committee, which is same whether I am a large company or a small company? Actually, these are forward-looking areas which both the regulators and the standard setting authority and NFRA have to get into. And in this area, I heard this term being used in the previous session also, and actually I don't have any issue with the term, but we must understand that businesses are businesses, and certain businesses need to retain confidentiality of the manner in which they do businesses. So the paradigm of how light passes is into 4 phases. You have opacity, opaqueness, you have translucence, you have transparency, and you have nakedness. Actually, most people, when they talk of transparency, they are talking of nakedness. I don't think it is proper to have companies report almost everything out. It is not in the interest of the businesses themselves. Transparency, I would support, but definitely not excessive transparency. Last is the quality which would come across all these 3 segments, whether it is regulations, whether it is reporting, whether it is standards and reporting, and whether it's security. And I would say the core of integral reporting of data as required, whether it is under LOD or the listing obligations, or listed companies have to put their data in public domain. Those, the more they are automated internally, and I can see a huge gap here in Indian corporate world. There are larger entities which have harnessed technology. Data is entered only at one place where there is a rigorous oversight on integrity of the data being entered. Thereafter, there is almost no manual interventions, and I can say that Indian mutual funds are actually come there. There would be some minor variations, but 98, 99% of mutual fund industry has arrived there. Banks are on the way, but not still there, because each has a different approach of technology and assimilation of technology. And I can tell you, this comes from the top. It does not come from the bottom in the organization. The second is, what do you report? For example, there was a case in Infosys whether there was a fraud or not. And you would recall in the last 1.5 years. And the board felt that unless they do an investigation, without determining whether it was indeed a fraud or not, they would not report. I would say that audit committees in particular need a very defined approach as to frauds, and better to disclose this approach in all your communication to shareholders and investors at large. I give you an example. I used to chair the board of one of the largest microfinance institutions, and we didn't then have the benefit of either UPI, or we did not have the benefit of Jan Dhan accounts. So we would carry cash to at least 30,000 centers across India, disburse money in cash to the ladies in groups of 5 or 6 in each of these 30,000 villages, and every week would go and recover money. You have to tell me if I'm running beyond time. Recover money in cash. Do you know our annual embezzlement, dacoities, thefts was 20 crores. The moment Jan Dhan account came, it fell to 7 crores, and the moment UPI came, it is almost negligible. You can see how systemic changes also impact the frauds in the system. But in regard to the governance in particular of reporting, there are multiple stakeholders. Very clearly, the two critical ones are the internal auditors and the statutory auditors. We have a problem here because there are two schools of thought. One school says that if an auditor continues for a reasonable period of time, the auditor understands the organization, is able to effectively audit and certify the correctness or otherwise of the accounts. Then you have the other school, no, a vested nexus develops between the company and the auditor, and therefore you need to rotate. There is no problem in rotation, but should it be every 2-3 years? Is that not a too short a period? And you know, we have one regulator who has prescribed that it has to be every 3 years. I think it is really silly. Large organizations, it takes at least 17-18 months. And Ramesh made a point of quality of audits by large and smaller organizations. And I can tell you that larger organizations, I have seen auditors. I am not saying alone the big four, but the next 4, 5 or 6 of them, is that every audit they have done of a company for last 10 years, they have detailed notes, and when the same problem recurs, they come back and tell to us that this happened 6 years back like this, you said this is the way we handled, why are you now saying this? I have not seen a small audit firm having that capability. I am not batting in favor of large organizations, but I am saying that if smaller organizations want to be treated at par with larger organizations, they must focus on quality. The last is in a very, very important area which is coming up as security, is the security of data. Security of data is in two levels. One is covering breach of data and as well as theft of data. Internal or external, because employees leaving carrying data, many large companies have control now. Because you know that external devices are not allowed on their computers, etc. That has been largely controlled. But the breach hacking is a large problem. You saw A.I.M.S., you saw CDSL in the last 1 month, what happened. And therefore, I would only say that auditors must concentrate in this area on the security of the system, which is as strong as the oldest system. The later systems which have been implemented in the organizations would be more secure, but something which is 6, 7, 8 years old is the weaker link and would be a cause for breach. It is like the weakest in a chain, the weakest link is the weak chain. And the last one is burdening of boards with several reportings. Actually, what needs to be reported is exceptions, not whether a certain thing is being done. You make a blanket statement and report exceptions. And the other is the continuity of succession internally as well as in the internal audit. Because I would put a large burden on internal audit in ensuring the integrity of data processes and controls.
Thank you, Ravi. You made some very interesting points which I think would benefit. I'll seek views from the other panelists too. Point number one which you made is, should regulations and standards be principle-based or rule-based? Now, there are arguments for or against. Some say it's very difficult to get around a principle, but it's easy to get around a rule. If you say more than 20%, it becomes an associate, you'll have 19.99%. But the reality is that as the world moves towards a technology environment, technology cannot be design based, cannot have principles. It needs to have rules. So increasingly, perhaps, and I'll seek the views of the preparers here, etc., they would like certainty, which is rule-based. Principle-based, the risk is you interpret the principle in one way, the regulator interprets it in another way. And then you will always have this battle. And that's where the issue of law, and I think Ved will also be able to comment on this. The second point, I think, which you made, alluded to whistleblower, and again here we have industry experts here who will talk about. The simple question is, when government receives thousands of complaints which are anonymous, they just pick it up and put it in the waste paper basket. But you as a private sector get a company, however well known the company may be, gets an anonymous complaint listing all of this. Are you expected to make that public without an investigation? So ask yourself that question. Aren't you, prejudging and reputations being tarnished by this shoot and scoot mechanism of anonymous complaints? This is a balance which I'm sure industry would have dealt with. So let me pass it on in the interest of time. I'll come back, and after your questions are there, Ramesh, your thoughts. You can focus also on, should the menu be improved, how it is printed out, or should the chef, the way he prepares the food, be improved? When you really are going to go to a restaurant, do you judge it by the menu, or do you judge it by the food? How would you do it? So is it with financial reporting. Is it your standards and your document, or is it the chef, which is you, and what do you do?
The problem with the way you stated is, it alludes to cooking.
Well, it is true. I have, there was a saying that, this is not me. Sir Arthur Levitt, the chief of the Securities Exchange Commission in the United States, in 1998, while addressing the New York Law School, said most financial statements in the United States were cooked. Some gently cooked, some completely roasted, is what he alluded to. So given that scenario, if you're not cooking for it to taste well, then obviously it will taste badly.
No, so couple of things. Also, this recipe is also leads to behavior. So let me start by saying that one of the fundamental things is also that rules, as you rightly said, ideally principles is great, but today the situation is too mechanical to apply just principles. Rules are necessary. because you can bake in and do your accounting properly, and then nobody can blame you for taking advantage of bending the principles. So if you look at the four actors here, the auditors, the audit committee, the investors, and the company management itself. From a company management itself, let me first touch upon reporting, the frequency of reporting, because that is a very important thing driving a lot of quality issues. The debate between quarterly and half-yearly. And what I am asking is that did all the mishaps that happened in the corporate world, did they happen in just one quarter? And were they not cooking over a period of time? And if the answer is that they were there, signs were there, but there was no one to detect it, or it could not be concluded, then the resultant question would be that what is the necessity of a quarterly result? And therefore, is it putting too much pressure on managements to kind of put up numbers so that they satisfy the markets? So this is one thing which I always feel that a half-yearly result is a far better idea. Although, frankly speaking, as a CFO, I'm very happy about quarterly results because they improve the systems. They improve processes to deliver accurate results quickly, and they improve even the software around the accounting and governance in general. But the repetition of the governance part every quarter is something which I think if we avoid, it's not going to cause a lot of damage to the industry, is my view. And, people who say that, keeping track of the quarterly results helps the investor to take better decisions, I would really say that, if in 6 months, and between a quarter and 6 months, if you are really confused, then it's a very difficult issue. So this is one thing which actually has some kind of underlying impact on how companies run their shop. So this is the first point I wanted to make. The second issue is about the financial reporting itself. So I'm sure that no audit committee member is able to qualitatively comment if he is given just the plain financial statements and the notes. It's very difficult. And if you have a large company with consolidated results with some 80 subsidiaries merged into it, it's even more difficult. So I think one of the things we should, and I found there are some practical steps to be taken, and there are some also probably some amount of, I would say, introspection on what is the required disclosure. So give an example. Today, after the quarterly results, the analysts ask you questions. If you really see some of the questions, or most of the questions, they are not from the published tables that you put up, barring the bottom line and some kind of EBITDA numbers, etc., top line numbers, but they are based on trends. They are based on margins per unit. They are based on ratios that are deteriorating. And they test it over a quarter, they test it over several years also, at times. Then begs the question that should the additional data that is given, based on which these analysts are actually putting up reports on recommending the stock to be purchased or sold, whether they are actually really needed as part of the financial statements. And there goes the answer, Mr. Ravikumar's point on principles, that if it is relevant for that industry to display those bunch of statistics, then those have to become part of their disclosures. What are they? It is something which is really industry specific. Can we do it so that people don't misuse it? I think today we've got a quite mature ecosystem of people who read the reports, who use the reports, and who prepare the reports. We can specify by industry certain additional information that's very key, and that helps decision making. Because ultimately we have to narrow down the gap between how the actual users, which is largely the investor base, how they interpret the results versus how we put out the results as CFOs or managements. So I think this is one point which I thought I will make. In terms of the practices on the audit committee side, I think it's, you're right, very right. 24 hours before to read the accounts and make a decision to support on various, I would say, statements made to the management is not easy. But I think it's a very useful thing to have a good quality meeting on critical issues before the board audit committee meetings, so that you are you're taking through the audit committee on key issues in a manner that they are on board, and also they have consulted, if they want to consult anybody other than just the management and the auditors. And I think that room, my principle has always been as a CFO that the focus should be on no surprise to not only yourselves every quarter, but also to your audit committee, your auditors, and the reader and the investor. If you keep that principle in mind, then you will take care that the audit committee doesn't, complain that, I got these results only 24 hours before, I can't, comment on many of the issues. So coupled with this, there's a whole set of, I think, side data that helps the audit committee to understand the results better. And I think that's very critical. That's an initiative to management. It cannot be that, I leave it to the audit committee to kind of take a view and decide if they are not happy with it or they get shorter time, I can't help it. That cannot be the stand, obviously. So that, I think, is one more area where effectiveness of the audit committee can be improved by the management, by supporting them with adequate or arming them with adequate, I would say, supporting data to appreciate the results and see where variances are there or management judgments have been taken for that quarter which they need to understand, so that if the question comes on the board, they are able to kind of support. So I think this is where I will stop, probably 2-3 points that came to my mind.
Thank you, Ramesh. I think you made a very bold and radical statement that quarterly reporting is no different from half-yearly reporting. So maybe we should move towards half-yearly reporting. I'll leave it to others to react on that. But before I move on to Sridhar, my specific request, Sridhar, is whilst you touch upon some of what has been spoken, if you can speak also on related party transactions and also deal with a point which Ravikumar made about whether regulations for State Bank of India should be the same as a cooperative bank. And you are part of a group which has large NBFCs, where the regulations for NBFCs should be the same as banks, or what is different, or is it a one-size-fits-all sort of a thing? Thank you.
Yeah. Thank you, Ramesh. Yeah, I think that's a very, very important point, that you can't have a regulation which is equally applicable to the largest organization and the smallest organization. And that is a problem that, because all the listed companies face all the time. And many a time the regulations come out from SEBI's side, I mean, maybe attacking only the largest organizations, and sometimes also on some of the smallest organizations which may be indulging in certain dubious practices. And in order to plug those bad practices, some of the good corporates and some of the large organizations also get affected. So I fully agree with Mr. Ravikumar and Mr. Ramesh. And I think it cannot be the same rule, and there have to be some thresholds, and then there should be some different provisions. But I know it is a very difficult task for SEBI also to lay down those thresholds and to differentiate. But that is a difficult task, but of course from our point of view, we would prefer that if they can do that, yes. And as regards the related party transactions, which Mr. Ramesh referred to, I think we have been grappling with all the issues relating to related party transactions for last several years, and in particular from last 1 year, from 1st April 2022, major amendments came out, and there have been several amendments which are come into effect from, which are going to come into effect from 1st April 2023. So as regards the amendments which came into effect from 1st April 2022, I think most of the companies have more or less resolved those issues, and I think they have maybe settled down with those amendments. So I will try to confine my discussions only with regard to the changes which are coming into force from 1st April 2023. And which is just around the corner. And since a lot of things have to be done well before 1st April 2023, and this is probably the time to act, or maybe the time was already there since last January or so. So, of the major changes in the related party transactions, which are going to come into effect from 1st April 23, of course, there are 3 major changes, and I'll talk a little more on the purpose and effect part, and I'll just only briefly touch upon the definition of related party, which is going to change with effect from 1st April 2023. Of course, there were changes from 1st April 22 as well, where it says that any member of the promoter group also would be deemed to be a related party, not necessarily that they should have 20% of the shareholding. And then any person or entity holding 20% or more in the listed entity, either directly or indirectly, and or on a beneficial interest basis, was also going to be deemed to be a related party with effect from 1st April 22, and that percentage is coming down to 10% with effect from 1st April 2023. So in other words, irrespective of whether a person is part of the promoter group or not, if you are holding 10% or more in a particular company, then you are deemed to be a related party. Even 20% threshold was actually posing a lot of difficulties for companies. So this 10% is going to make it extremely difficult to comply. And not only that, to treat, say for example, some financial institutions or say FPIs or mutual funds, etc., holding more than 10% shares in a particular company, to treat them as a related party would have a lot of unintended consequences. Because if there is a material RPT which has to go to the shareholders, the related parties cannot vote. And these shareholders who are holding 10% or more will not be allowed to vote, although they are absolutely not connected with that particular transaction, and they are not part of the promoter group, and they are probably only passive investors or maybe strategic investors and so on. So this is an unintended consequence. I think if SEBI can look at it, at least that threshold of 20% should not be reduced to 10%, but as of now, I don't think there is likelihood of any change there. So, and then there is another side effect because of that, that deeming concept, because of Ind AS 24, would make even a non-related party become a related party, because suppose this shareholder holding more than 10% is, let's say, holding 20% or more in some of the other entities, that entity also becomes a related party of this entity. So, so then it just goes on extending further and further. So it can lead to a lot of impractical complications for the company, and even for that particular shareholder holding more than 10% who will be deemed to be a related party. It is a little unfair because their voting rights are curtailed to that extent, and many of them may be interested in their voting right as a fundamental right, and they may be losing out on that. So that is one point which is coming into effect from 1st April 23. Then the other part which is going to come into effect from 1st April 23 is about the definition of related party transactions. Of course, you are fully aware the definition of a related party transaction. It is a transaction involving a transfer of resources, services, or obligations between a listed entity or any of its subsidiaries on the one hand, and a related party of the listed entity or any of its subsidiaries on the other hand. Of course, this came into effect from 1st April 22. But now what is going to come into effect from 1st April 23 is that a listed entity or any of its subsidiaries on the one hand and any other person or entity on the other hand, the purpose and effect of which is to benefit a related party of the listed entity or any of its subsidiaries. So now, which if you, and regardless of whether a price is charged or not, and again, whether it is for a single transaction or a group of transactions in a contract. So this particular thing, I'm not going into the exceptions which have been made to some of these definitions. I think Mr. Ved would be taking care of some of those exceptions, like the exceptions with regard to preferential issue or a rights issue or a bonus issue, buyback or consolidation, subdivision, etc., fixed deposits and so on. So without going into that part, so this purpose and effect has become an extremely contentious issue, and it is a fairly complicated issue for all corporates to comply. And of course, one can probably look at the genesis of these provisions, and many of you are aware, SEBI had set up a working group in November 2019 to discuss RPTs and to strengthen the regulatory norms relating to RPTs. And while doing that, they had made some observation that many creative or innovative structures were being used by some of the companies, and only for avoiding classification of certain transactions as related party transactions, and thereby they were able to avoid regulatory compliance requirements. So because the working group and SEBI had noticed that part, and in fact, in particular, they had noticed use of many complex structures whereby a particular party could be treated as a non-related party and so on. And the other was the transactions undertaken by a listed entity with unrelated parties, but intended to benefit some related parties, or instances of loans being given to an unrelated party, which in turn gives such loan to a related party. So for example, if the market rate is 15%, if it's given at 5% to a non-related party, and the non-related party in turn gives it to a related party at 5%. So indirectly, this listed company is giving it well below the market rate, and it is not an arm's length transaction, but this was one of the dubious ways by which certain things were done. And to plug these loopholes, this particular provision came into effect, saying that the definition of RPT should be broadened to say that even where the purpose and effect is to benefit a related party, directly or indirectly, then that should also be covered as a related party transaction. So the intent is unquestionable, absolutely correct, but the practical issues and challenges for good corporates can be enormous and can be absolutely mind-boggling. And if you go point by point, every word in that particular clause can lead to several interpretations and can, of course, result in many, many unintended consequences, which will be very, very impractical for companies. For example, there are 3 legs to the stool, which I read out. One is, on the one side, you have the listed entity or any of its subsidiaries. And as Mr. Ramesh, Ravikumar and others have mentioned, the subsidiaries could be very large for many large companies. It can be 100, 200, 300 and so on. So listed entity or the subsidiaries on the one hand, and any other person or entity on the other hand. So which means any other person on the other hand would mean the entire universe of all transactions of the companies, which can run into several lakhs for large companies. So it is that kind of transaction. and who would be the ultimate beneficiary. The ultimate beneficiary being a related party, again, of not just the listed entity, the related party of the listed entity or any of its subsidiaries. So that means you have to look at all these three aspects, and which, as Ramesh also mentioned, it can be thousands and unimaginable numbers. So one has to keep a list of all those transactions and related parties. And identification of these three legs itself can be a very, very challenging task. And assuming that we are able to cross that, how do we decide what is the purpose and what is the effect? And what kind of benefit are we talking about? And how do we define the purpose and effect? All these aspects will come in. For example, benefit. The word benefit can have very wide connotations and can be quite subjective as well. And there can be many transactions, any number of transactions you can think of, where one can say that the benefit has been received by one of the related parties. For example, just to give a practical example, say, suppose an automobile company sells its products to its dealer. Dealer is a non-related party. And the dealer arranges finance through a financing associate of the automobile company. He arranges finance for the customer. So in this particular case, here one could say that the benefit is accruing to the financing company because its business enhances, or one could say that this transaction is there because of which this automobile company is able to sell more. So all kinds of benefits are received, and therefore all such transactions will have to be considered as related party transactions. Everything will have to go to the audit committee. If one takes that kind of stand, then it can be the entire, in fact 50% of all the sales will have to come as related party transactions, and 50% of the financing by that financing company would become related party. So I'm sure SEBI did not have this kind of transaction in mind. So they probably are not considering what is the normal benefit, because this kind of benefit is part of the ordinary course of business. And although, of course, mind you, that in SEBI, that ordinary course of business or the arm's length transaction concept is not there. That is there only in the Companies Act. And assuming that is getting extended here, so the benefit, we should restrict it only to the normal benefit. And if it is an undue benefit, then it can be deemed to be a benefit which is going to a non-related party, to a related party. So that is one part. Then the audit committees, audit committee in turn will have a huge task to list down all those, to identify all these transactions. And then it is an unnecessary burden on them, because they are going to say that there are no such transactions and everything is in order. And then, as I mentioned, the purpose and effect, both the conditions have to be met. So while the contract is being entered into by the listed entity, the purpose of that particular contract should be such that the benefit is to be given to the related party. And it's not only the purpose, the effect also should be the same. If both the conditions, purpose and effect, both the conditions are met, only then this provision would get triggered. But at the same time, these are our interpretations, and whether the audit committee or the management, senior management, etc., will have to go into minute details and to find out whether there is any such transaction, whether they have to act like a watchdog or whether they'll have to go like a bloodhound, as auditors would say. So all those questions may come up. And it would be good if SEBI can come out with good FAQ on this subject, removing all these ambiguities and the doubts. And then clarifications would also be very much required. But considering that, and again, the other aspect regarding the subsidiaries, because there can be, it's not that it's only the domestic subsidiaries, it can be the foreign subsidiaries as well, because there is no exemption given to the foreign subsidiaries. And in foreign subsidiaries, the rules could be quite different, and then they may have a certain confidentiality, privacy laws, etc., because of which they may not be able to share that information, or they might not want to share the information because of they are outside this jurisdiction and so on. So how does a company comply with when such information is not made available to the company? So these are a few practical issues which come up. But since there is no way out but to comply with it from 1st April 2023, few companies are grappling with this and then they are finding their own solutions. How far they are right, of course, has to be seen. But they are taking a practical way out. So, for example, who has to give a certificate saying that there are no such transactions? Or these are the transactions which have been entered into, which are giving purpose, the benefit to a related party. So whether it should be the CFO, whether it should be the compliance officer, or whether it has to be the internal auditor, or whether it has to be the managing director, or who, would be the first question that can come up. So one practical approach followed by some companies, maybe some companies like L&T, etc., they might be taking some certificates from the chief executives of the respective business organizations, the units, divisions, etc. Or some of the other companies could also be, yeah, sorry.
Yeah, so Sridhar, I think you've covered very adequately. I'm not sure whether these legislations have made us wiser or more confused. All I can say is we also have to do business, and I'm not sure whether there are any transactions which are non-related party transactions given what you have described, and also everybody is related to each other through Adam and Eve finally. So maybe we are heading towards that, and all I can say after hearing you that we all need to look towards Ved, because maybe he's the only one who can throw some light or wisdom in this. Ved, all of them are looking towards you.
Thank you. I'll keep my comments very brief. I'm aware we are over time. And just let me just ask one question. And the concept of related party in the Companies Act, which is, I think, maybe more a beginning in terms of how the concept came across. There were some provisions in the 1956 Companies Act, but the first time the definition of the term related party came was in the 2013 Act. If you see the standing committee reports that preceded the 2013 Act, there was some discussion on why this is required. Now, obviously, there have been a lot of reasons why the definitions came. There have been a lot of reasons why the rules have come, why the rules have been got modified and have got strengthened. There can be debates on whether we need to legislate for the exception. There can be debates on whether we need to go so wide. But I think, as Mr. Ramesh has said, let's focus on what we have rather than what ought to be or what can be or what should be. So going with that theme, I think just to demystify this, the first question that clients tend to ask me is, who is the related party? And I ask them, what is your purpose? Because believe it or not, there is a separate definition of related party in the Companies Act. There is a separate definition in AS 18, which was the old accounting standard which is still applicable to some companies. Not many, some smaller ones. There is a definition that is available in Ind AS 24, which is applicable to listed and certain unlisted companies. And there is a separate definition of related party under LODR, which includes both Companies Act and listing regulations and a few other heads that I think Sridhar has covered, and I don't need to get into. There is also a concept of related party in tax laws. So the question I ask a client is, under which law are you asking me the question? Now coming to a related party transaction. A related party transaction effectively follows the same pattern as a related party. There is a separate set of regulations under the Companies Act. There is a separate set of regulations under AS 18 and under India's 24, both of which are separate, because India's 24 follows your IFRS standards. And there is a separate set of related party transactions under LODR regulations, which again Sridhar has covered, which is wider than all of this. And there is a separate set of so-called related party transactions with slightly different names and tax laws, both direct and indirect. So when someone asks me what is a related party transaction, again my question is which law? Or which set of laws are you asking me the question? Because more often than not, someone who is a related party under one law will not be under the other. A related party transaction of X with Y may be a related party transaction for X and not for Y. So a transaction of Y with X will not be a related party transaction for Y, when X to Y will be a related party transaction for X. So without getting into those complexities which kind of form a part of the advice that we end up giving clients, and clients like Sridhar, clients like Ramesh, clients like others who are here, they end up actually facing this, whether they are in board or whether they're in management. So I think I'll just keep a few themes here for all of you to think about in terms of this animal, this creature called related parties, which 10 years ago did not even have a definition in our corporate law. The first question is, how do you determine a related party? This is just to kind of simplify what is otherwise a fairly complex topic. Second is it a related party transaction or not? Let me give you an example of why this is relevant on who is a related party. The recent SEBI regulations have included, as Sridhar has said, some transactions involving subsidiaries. Now there are some exemptions for wholly owned subsidiaries, transactions involving wholly owned subsidiaries, but not subsidiaries that are not wholly owned. Subsidiaries that are not wholly owned have other shareholders who are third parties. Now, would those third parties end up being related parties of the subsidiary and then consequently of the holding company as well? So I think the question is, who is a related party becomes relevant. What is a related party transaction becomes relevant because one of the exceptions that Sridhar referred to is fixed deposits for transactions with related parties. But surprisingly, there is no exception for savings and current account transactions. So are they related party transactions? Because fixed deposits are exempted. Third question is, how do you determine the thresholds? Do you determine them based on consideration in the contract? Do you determine them based on payments? How do you determine thresholds? The fourth question is, how do you determine, these are slightly older questions, but they become relevant from time to time. How do you determine what is ordinary costs, especially for a one-off transaction? How do you determine what is arm's length? Pursuant to the new regulations, how do you determine what is a modification? For example, certain contracts have LIBOR, loan contracts have LIBOR as the interest rate. Now LIBOR is no longer the benchmark, it has changed. When you change the benchmark rate from LIBOR to something else, is it a modification in a loan agreement? Because that has a separate set of important questions that arise with respect to whether you need approvals or not. If it's a modification, is it material? Is it a material modification if you're changing the interest rate or a loan, or you're changing the rate card on a contract for everyone, whether related parties or not related parties? The question then comes to, how do you determine the thresholds? When do you have to go to the audit committee? When do you have to go to shareholders? It seems simple enough when you read it, but when you apply real life and practical situations, it kind of tends to get a bit complex and you have to apply a lot of judgment when you advise a client. The next, I would say, set of questions arise on interplay between other laws and this new set of related party regulations. For example, determination of promoter group. So depending on how you determine your promoter group, for large groups, your related party can be either 20, can be 200, or can be 1,000. And couple of other themes that we end up dealing with for clients on related parties fairly frequently are For example, if you are entering into a related party transaction with your counterparties, holding company and subsidiary, and if one of them in the chain is a related party, do all of them become related parties? Do all of them become related party transactions? If I and my subsidiaries enter into transactions, do you need to aggregate them to determine thresholds? So these are just a few examples of the various questions that actually come up on account of these rules. For each of these, there is no single answer, and well, the way the rules are worded, I believe, rightly or wrongly, that there can be no single answer. I think the only thing I want to end this part with is, to a large extent, a lot of these, we know why the rules are there. The fact that better governance of subsidiaries is required has been in several reports of the across regulators for the last 20 years. As in, if I had to take the names, I would take another 5 minutes, so I am not going there. The point is, what should be this better governance of subsidiaries and related party transactions? We have a framework today, whether you like it or not. The question then is to be able to anticipate the challenges, to look at it, including as Sridhar has very eloquently set out the purpose and effect test, which I'm not getting into because he's covered it. The question is to identify the challenges that apply to you, to think through the fact that and none of these regulations are a surprise. They have all been notified 6 months, 8 months, 1 year in advance. The question is, it's up to us as industry, either to go to the regulator and ask for the clarifications, or to look at it and ascertain to what extent these apply and to what extent I need to take steps and put systems and processes in place such that I can work towards compliance. I think that's it, Mr. Ramesh.
Thank you, Prerak. I think you've sufficiently scared all of us. Definitely me, I chair a lot of audit committees. After hearing you, I think financial reporting is a walk in the park as compared to related party transactions. I'll throw it to the audience rather than I'm scared of asking questions because it will scare me even more. Yeah, please.
So I have a question to Mr. Ramesh. Okay. Okay, PR Ramesh, sorry. Sorry. So you mentioned about, Infosys not reporting a fraud because they were...
I didn't say Infosys not reporting.
Okay, sorry. Mr. Ravikumar.
I said the question is, should every company report every letter which comes, which is anonymous, just because somebody wants to know or the regulator wants to know? Whereas the government receives thousands of letters, if it's anonymous, they just put it in the waste paper basket.
But if that is reported, wouldn't it bring accountability?
Exactly.
That is my first question.
If you say that is so, if I write a letter saying that you are a fraud, would you be happy that comes up to be made public even before you are proven to be a fraudster?
No, but it's a listed company we are talking
It could be listed. It could be any government is even bigger than listed. They receive thousands of letters every day. So the key is, should there be some substance, and to determine the substance, you need to have some investigation done, right? Otherwise, we are postmen. We might as well, and in Infosys case, from what I understand, letters went even to the Securities and Exchange Commission, PCAOB in the United States, and to SEBI, to everybody. Today, the digital world, you can mark copies from President of India down to everybody, including Secretary General of the United Nations. So the question is, what do you want the company to do? And why? And what will you do with it?
Yeah, the second question is...
The way some companies have now started handling this issue is, each company needs to have its whistleblower policy. So I have seen companies which specifically refer to anonymous complaints. And they say if it is an anonymous complaint and has specific variable complaints which can be investigated and accountability fixed, they would only then look at treating it as a complaint under whistleblower policy. Because quite often many whistleblower policies are very generic in nature. They don't give you specific instances. So I have seen at least 2 companies where they have amended their, after this Infosys incident, saying that if they are generic in nature and there are no specific details, then it would not be covered under the whistleblower clause.
Second question is to you, Mr. Ravikumar. There was a discussion on, diluting norms for small listed companies vis-a-vis large listed companies. Wouldn't it be like setting an easy question paper to dull students of the same standard? And would it be a better idea to bring them up to scale using technology like you did with UPI and Jandan accounts?
Actually, see, the small versus big, the challenges are quite different because they are different, I would say, from the way the culture of the organization and the governance points. So I would suggest regulators that the regulation should cover the larger organizations in a meaty way and the smaller organizations through a rule-based approach. You do this, you don't give them a choice.
Third question
we
is...
have dealt this subject even while looking at accounting standards, whether they need to be separate standards for small and medium industries. And that's how separate set of standards, because what is required for a large entity is too much of a burden on small and medium enterprises. You can't prescribe a jacket to a villager when he has no read for that sort of dress code.
And just one more point is, of course, SEBI in its own way is trying to do that. In the sense, for example, BRSR, they'll say only the top 1,000 companies will be covered and this and that. That kind of thing, there are some provisions like that.
My last question is to Mr. Prerak. Like the government is coming out with uniform civil code. Is there industry licensing for uniform laws in various, set of regulations which we have? Like the same definition of related party across taxation laws and company laws, and is the industry licensing towards it?
See, I think I can't speak for the wider industry, but each law has a purpose. Each law has a reason why the term is defined in a certain manner. So you would want a certain definition for tax law purposes, which is slightly different from a definition for a securities law purpose. Uniformity may or may not work, but at least I can say for certain, I can't speak for the wider industry, but I am certainly not having any conversations with anyone. The question is not the fact that whether you should have or whether different definitions are wrong. The point I was trying to make is that there should be an understanding that the yardstick for the same concept is different, each of which may have different purposes, and it is important for industry to understand and implement it accordingly. That's all.
Thank you. You all have been very patient, so I will not restrict your questions. No, you raised your hand, surely. We have been speaking, so you have been patient and staying behind. So feel free.
Yeah. This question is specifically for Mr. J. Sridhar, a good friend of mine and a co-professional. We have discussed throughout the day regarding the corporate governance and various aspects, including the related parties, which is most complex subject. And we have discussed risk and fraud and everything, accounting standards, everything. I think in these discussions, what do you think, Mr. Sridhar, the role of company secretary and compliance officer, who is day in and day out, working on these matters and providing the support to the management and complying with these requirements? So could you please throw some light on?
Yeah, I think it's a very, very interesting question, and I think compliance officer and company secretaries, they have a very huge role, and particularly with regard to RPT compliances, I think they have to lead the compliance, because others may not be that thorough with all the intricate provisions on that in the Companies Act or in the SEBI regulations or of course accounting standards as well. So for example, setting the system and to ensuring a good method by which the managing director can be satisfied that these are being complied with, and in turn, based on the certificate of the managing director, to satisfy the audit committee that all these compliances are being made, etc. So setting the system, setting the processes, etc., I think would be a major role for the compliance officer and the company secretary. And I'm sure, I think they are all doing a fantastic job there. Yeah, thank you.
I just want to jump in there. See, today what I'm realizing over the years, earlier the CFO, before the company secretarial profession became complex, CFO used to have a lot of handle on the entire scope of compliance and corporate governance. Now what is happening with the amount of, and if you're a listed company especially, this jugalbandi of the CFO and the company secretary is very critical. I think if they play this properly, then a lot of things are under control. And I mean, it's not just left to the company secretary today, because there's so many commercial issues that need the CFO to have understanding of the compliance, and at the same time, how it is to be finally taken through the board is a separate matter.
Thank you. So I think we've had a long day, and thank you very much for your participation and your patience. With this, I should thank my fellow panelists, Dr. Sridhar, Ravikumar, Ramesh, and Ved. And thank you, everybody. I now hand over the session to the organizer.
Thank you, sir. On behalf of CII, I would like to thank all our esteemed speakers for their insights on the topic. It was really useful learning for everybody. And thank you all the participants for staying throughout the summit with us. I hope you like these sessions. Thank you so much. Thank you, everybody.